Good morning, good afternoon, and good evening, everybody. The last week has seen dramatic moves in US and global equity and debt markets following the announcement of trade tariffs by the US administration. Pressure and announcements have been ratcheting up until obviously last night, European time, when Trump announced a 90-day pause. 10% is a new baseline for most countries, with some sectors remaining higher, and by contrast, China tariff has been raised to 125%. US markets reacted strongly overnight. Asia and Europe today will likely follow. Market volatility is, of course, nothing new. Our experienced investors have seen such volatility before throughout their long careers. Stability and doing the best for our clients in these episodes is key to what we do. We've gathered here today some of our leaders of the investment teams to discuss what is happening, how we look through some of the short-term noise and market moves to really establish what are going to be the long-term implications of the events that we're seeing today. I'm Henk-Jan Rickerink, Global Head of Multi-Asset, Real Estate and Systematic here at Fidelity International, and I'm delighted to be joined today by Niamh Brodie-Matura, Chief Investment Officer for Equities, Matthew Quaife, Head of Multi-Asset, Mike Riddle, who manages our strategic bond funds, and Oliver Trimmingham, Sector Leader on Industrials within the Fidelity Research Team. Welcome to you all. And just a note, if you have any questions to the panel, please send them in via the Q&A app, and we'll get to as many as we can later on in the webinar. Matt, if I can turn to you first to set the scene. How has the past week, and indeed the first few months of the year, changed the outlook for the US economy?
Yeah, thanks, Henk-Jan. Yeah, so we came into the year in the US really looking at four major domestic policy areas. That was immigration, tariffs, fiscal policy, and deregulation. And each one of these has a different impact on growth and inflation. Some of them push them up and down. And the key question was, what was the cocktail that we got? What size and which order would we get them? And what's really induced inflation here is induced the volatility here is the tariff policies, which have become bigger and bolder and more immediate, albeit now with that 90-day pause. And that's really spooked markets. So we've, rather than a cocktail, we've got a little bit more of a shot of those in the last week or so.
Thank you. What does this tell us, Matt, about expectations on growth and inflation for the quarters ahead?
Well, part of this volatility is the uncertainty around that. But what we do is we try to think in different time frames that really can give you clarity. So over the long run, it's really significant that the policy is looking to really rewire how global trade works, rewire some political allegiances. And this is going to have a profound effect on the world, where earnings happen, which companies are going to do well, how countries work together. And that's something we're deeply, deeply looking at the moment. On the medium term, so let's call it more like the 3 to 9 month type area, this uncertainty is going to have a real impact on consumer and corporates. So the confidence to spend is going to be quite low, and that's going to have a significant downward impact on growth. And then in the very short term, it's really driven by the news flow and the different policies, and we've really got to stay on top of that. But that's more going to be an up and down volatile area. And some of the data can come in quite strangely. You know, sometimes you get buying before tariffs comes in, you get different buying patterns through the next month. So it'll take a few months to really see the impact on hard data.
Thank you. Turning to you next, Niamh. It's been one of the most volatile weeks in history for US equities. Can you share your view on what's really happening here?
Sure. Thanks, Henk-Jan, for the question, and welcome to everybody on the call. There's a saying that there are decades when nothing happens, and then there are weeks when decades happen. And it certainly has felt like that over the last week in equity markets and in markets more broadly. Let's try to strip back the noise, the rhetoric, the ping pong in terms of policy, and let's try to drill down to what has actually happened and driven the volatility that we've seen in the equity market. I'll focus on most specifically. What has happened is that the ground has shifted. You could even say that the tectonic plates have shifted between what is usually the absolute number one driver of the equity market, and that is earnings expectations. But what has also happened is that the ground has shifted between what are sometimes the secondary drivers and every now and again, actually the most important drivers. And that's the long-term structural growth that you're willing to underwrite in the market. And what is your required rate of return for the risk that is perceived in these assets? So those are all critical drivers, and the ground has moved underneath all of them. So let's unpack that a little bit. Let's do a little recap on where we've come to year to date. I know all of our clients will already know this, but as I've said, so much has happened. Let's go back over the journey a little bit. So as we came into 2025, our economics team here, led by Salman, have been increasing their expectations of recession and stagflation in the US, and therefore with global economic implications through the year. And that was on the expectations of some tariffs and also on the expectation, or sorry, not on the expectation, on the data that was showing a loss of momentum in the US economy. And that was on small business side, on consumer confidence and so forth. So we had these two things dragging on expectations. Stagflation or reciprocal tariffs, as were indicated last week, would change the game. They were very significantly steeper and very significantly broader than the market was expecting. And what does that mean? That means that you can push the biggest economy of the world and many of the other economies much more firmly towards recession. And we saw that happen in market expectations. And see, indeed, our economics team were also worried about what this meant in terms of the probability of recession, but also the potential extent of that recession. Let's remember for equities, and this is really critical, US economic growth and innovation globally, they have been the oxygen driving the equity market for many years. And suddenly, the oxygen leaves the room. So that's what's been happening in the last days and over the last weeks. So the additional element, so unpacking those additional drivers, what you will pay for these earnings in the longer term structural growth. We talked about this towards the turn of the year, that while earnings expectations are robust, while you have that momentum, while you have that positive change, that is more important than valuation. And it can even drive valuation upwards. It can mean that people are more willing to pay for that structural growth into the future. But when that becomes vulnerable and when that momentum starts to roll, the marginal investor will start to say, hang on, what am I actually paying for this? So the high valuations that we had in the US, not globally, but in the US, they were partially a function of a higher quality market, but they were also partially a function of this pricing in of growth expectations in advance. And that vulnerability came to play, that if you are concerned about earnings expectations, you will also see multiples come down at the same time. So you're not just talking about the earnings risk, you're talking about a multiplier effect. So now let's bring us up to the current date, and we have a pause in reciprocal tariffs with some countries, not a cancellation, mind you, a pause, and a continuation of higher tariffs with China. Where does that leave us? The risk to growth from that is reduced for two reasons. Firstly, the actual tariff risk to growth itself has gone away. And secondly, as a signal that the US administration is not completely insensitive to the signal and the reaction of markets. And that does matter, because market participants were really questioning that in recent days. So are we out of the woods? This is a separate question. My primary area of concern at this point is that the market is looking for double-digit earnings growth in the US in 2025 and in 2026. So from my perspective, I think we need really sharp pencils in terms of understanding what is actually going to happen in terms of corporate earnings in the US and in many different markets. It is not all gloom and doom out there, and it is not equal across all regions, but we need to be really discerning, and we need to readjust for the new reality. When facts change, you change your expectations, and thankfully on our side, we have really fantastic analysts and portfolio managers that do the work to actually recalibrate for the new reality. We go through region by region, and we make sure that our clients' portfolios have that combination that they would expect of both resilience and continuously looking for opportunities.
If we step back, you've worked through several crises now since the 1990s. And it's also interesting to compare and contrast them, especially after what happened yesterday. Does this one look a little bit more like the COVID sell-off than any other periods of stock weakness, or how would you think about today in context of other previous times of market stress?
So that's right, Henk-Jan. Like many of the members of the investment team in Fidelity, the portfolio managers, the senior analysts, I've seen a lot of volatility through my career, and I actually would remember the first 5 years I saw the Russian financial crisis, the dot-com bubble burst, and then the aftermath of the 2000 of the September 11th attacks. The lesson from this is that volatility in the equity market is normal. It is to be expected, and it does not at all detract from the fact that over the long run, it is within public assets, the highest returning asset class. But what separates investors from speculators is understanding that, having patience, and investing through the volatility and through the cycle. So that's the critical point to start with. In terms of whether this looks like the COVID crisis and the COVID stock market correction, or whether it looks like something else, no crisis is ever the same, but things do rhyme. There are playbooks that can help us ask the critical questions to understand how this one will be similar or different to previous crises. Starting points matter. So the starting points that are really critical: where were valuations at the start? Where is the leverage? Is there leverage, and where is it? And the third is, again, we always come back to earnings. What is the health of earnings? Are they stretched? Are they resilient? Are they high quality? So I think those are the three critical questions. When we think about where we are right now, valuations in the US did look elevated. As I said, there was a fundamental reason for that, but even allowing for that, they did look more stretched. In the rest of the world, they were not stretched. In Japan, in Europe, you were looking at much more typical valuations compared to history. In the UK, in emerging markets, you were actually looking at cheap valuations relative to history. So you did have that regional dispersion. The important point when we think about how does this period of volatility compare to the past, we were not in bubble territory. We were in a case where one major super important market was stretched, but it did not look like the dot-com bubble. It did not look like a case where greed had driven valuations to levels that were completely unjustifiable based on any growth scenario. So that's point number one. On leverage, the corporate sector globally is in decent financial shape. Balance sheets are robust. Banks look robust. The regulators have been working for many, many years on ensuring that they are more capitalized and that they have dampened down issues that could cause systemic stress. Is there leverage somewhere in the world? Yes, for sure. There always is. Are there issues in financial markets that could cause the type of gyrations that cause flash and panic on a short-term basis? Yes, for sure. But we don't see flashing alarm bells on that front at this point. So then we come to the last critical question: are earnings stretched? This is important. Is the quality good? Are the growth expectations reasonable? And for this, you have to work it through. You've got to work it through country by country, sector by sector, stock by stock. So that's exactly what we're doing right now, and we're trying to understand on an investment by investment level whether the valuation continues to offer an attractive opportunity for our clients. So to come back to your original question, Henk-Jan, is it like COVID? Yes, there are similarities. There are more similarities there than with periods of really major crisis and crash in the past. To me, how I would characterize this is what we were talking about at the turn of the year. We are late cycle. We've got late cycle volatility here, and it's being accelerated or accentuated by the fact that some of the well-established rules of the road are being thrown in the air.
Thank you. That's probably a perfect segue to moving to Oliver. Oliver, what have our analysts been doing both to plan for and then react to the various announcements we've seen around the tariffs?
Yeah, hi, Henk-Jan. Thank you for the question, and hi, everyone. In short, we're busy. We've been very busy over the last few weeks. I mean, to say it's a complex and fluid situation, I think, is an understatement. In the first instance, what we as the analyst teams do here at Fidelity International, I think this is a number crunching exercise. We as a team are trying to work out the first order impacts of what these tariffs mean for the companies we cover. So to give you an example, many analysts in the industrial sector have been looking at the US businesses of the companies under coverage, trying to work out with our in-depth knowledge of these companies, talking to the companies and other experts about what the source of origin are for the cost of goods for these companies, and therefore trying to assess what the blended average percentage increase of the cost of goods sold would be for affected companies. And that's the first order in effect. And in a sense, you know, I think that's the first thing to do. But to give a sensitivity to our portfolio managers, try and think about where risks might lie. But the more interesting work, and I think where we really can bring to bear our expertise and sector knowledge, is thinking about the second order effects, the third order effects, and thinking longer term. So that might be, you know, do the companies we cover have excess capacity in the US that they can use? Do these companies have pricing power to pass through the impact of inflation on their cost of goods sold? Importantly, is there a difference in the footprint, the sourcing footprint between their competitors? Because for some companies, this can create a significant competitive advantage. Yeah, and so that's what we're doing, you know, when we're at our desks, running through our spreadsheets, communicating with PMs. The other thing we're doing is, you know, we're in the information gathering stage. It's not like we're reacting to headlines, but we're trying to work out what's going on. And I think here at Fidelity, you know, one of the key advantages we have is a long-term, deep relationships with the corporates, and we have boots on the ground. You know, to give an example from my own personal experience, last week I was at a trade fair, an industrial trade fair in Germany, you know, with the expressed intention to think about how AI was infecting industrials. But the beauty of going to a trade fair like that is I can speak to public and private companies about what they're seeing in terms of demand, how they're managing the supply chain, how this is affecting their business. And, you know, trade fairs, you're not speaking to the CEO at that sort of event. You're speaking to people who are dealing with this on day-to-day on a day-to-day basis, and I think that's a real advantage, having boots on the ground, people speaking to people who are involved in it. And then I think the third thing is, you know, here at Fidelity, the analyst team and the PM team, you know, that there is a collaborative effort, and you know, we have experts around the world with a full value chain, a full view of the value chain, which can be really valuable at times like this. Again, to give an example from my own experience, we have a Teams chat of everyone who analyzes companies in the aerospace sector, and earlier this week there was a lot of busy work going on trying to work out which rare earth metals were used in aerospace engines or other components for the aerospace sector. And you know, that's a very complex, detailed discussion, but that sort of collaborative effort, bringing everyone together to try and work out answers to difficult questions like that, is a lot of what we're spending our time doing at the moment.
Thank you. That's fascinating to hear. Let's take this to an example. What immediate consequences do you and the research team see for the industrial sector coming out of the work you've done so far?
I mean, it is changing. So my answer to that would have been very different yesterday than it is today. If we just think about what would have happened, you know, what we were thinking about yesterday, what would have happened if the reciprocal tariffs had stuck? You know, very simply, prices would have gone up. And, you know, I think everyone can think about the obvious examples of that from consumer electronic devices or things that the consumer would buy, but it's also very relevant in the industrial world. We spent 30 to 40 years globalizing industrial supply chains, and you can't dismantle that overnight. And so the result is that industrial companies in the US in particular, costs were going up and therefore prices were going up. And that's the first immediate consequence. The other thing is, you know, because of globalization, we have this complex, deeply integrated supply chain built up. This disruption and the uncertainty it's caused is creating havoc in supply chains. We've seen some suppliers and some sectors already invoking force majeure clauses. Companies I'm speaking to talk about the amount of paperwork they're going to have to fill out to prove the origination of the components they put into their machines. And all of that is putting sand in the gears of an already quite vulnerable supply chain. So I think we were seeing some signs of supply chain disruption. And, you know, this is going to become even more pertinent now that we've seen this pause in tariffs. But, you know, there've clearly been signs of a rush to pre-buy goods and industrial components ahead of tariffs coming in. And with the pause now announced for 90 days, I think we're only going to be pouring fuel on that fire, that industrial companies in the US are going to be rushing now to buy components and raw materials and systems, modules that they need for their machines, hand over fist in the next 90 days, just in case there is, you know, the negotiations don't prove to be fruitful. So I think we've seen a pre-buy. We're going to see a bigger pre-buy in the second quarter of this year now. And then the third sort of longer term consequence is, yeah, when I speak to companies, and I think it's evident in macro data, as Niamh was talking about, is, yeah, business confidence is shaken, and CapEx decisions, I mean, they're not being cancelled, but they're being delayed, because why would you sanction a new production line for a widget in Mexico, let's say, if you're not confident what tariff regime you will be in next year when that production line is up and running. So I think another consequence we're seeing is caution on the side of corporates for industrial capex. That might be short-lived, but those are some of the consequences that we're thinking about at the moment.
Thank you. Mike, turning to you, how have you and the wider Fidelity fixed income team been navigating the extraordinary volatility you've seen in fixed income?
Great, yeah. And thanks for having me, and good to see so many people on the call. I mean, I think first of all, just put the volatility into some kind of context that we've seen in recent days in fixed income. If you look at rates markets where it's been particularly violent, I mean, one measure of this is the MOVE index. So the MOVE index is a measure of implied volatility across the US yield curve. And we saw volatility in treasuries that we've very rarely seen since 2008. So it was slightly higher in the banking crisis in the US in early 2023. But other than that, we were at the highs of what we've seen during the COVID era. So extraordinary volatility in government bonds. And a lot of that is focused on the longer end, as well, as we have a lot of uncertainty about tariffs and what the fiscal response might be. But I think actually picking up on a point that Niamh just mentioned about volatility generally, I think it's a really good point that we always get volatility. This always comes. And yet when you look at what markets are pricing in, sometimes markets think there's never going to be volatility ever again. So I want to try and put this volatility in the context of just the last 6 to 9 months. I mean, just have to wind the clock back a bit and think about what's been happening. Last summer, we had markets panicking and pricing in sort of intra-meeting Fed cuts. Then we had Trump obviously elected and winning the election. Then we had the market in the beginning of January saying, US growth is going to be 3% forever. And, credit spreads were near all-time record tights. Obviously, equities are at record highs. So, there was no volatility priced in. And that might be some of the reason why we've seen so much volatility just in the last few weeks, is because you're coming from a starting point where there really was no risk of anything priced in. So I think that, we're now in an environment, obviously, where, as been discussed already, we're looking at weaker growth. There is more uncertainty about policy response. So, I'd say that there has been a lot of volatility in rates markets. There are some areas, though, where you've seen less volatility maybe than what you'd have expected. And I think particularly in credit markets, we have seen credit spreads widen, and that's normal in a volatile environment. Equity volatility and credit spreads tend to move together. But you've gone from high yield credit spreads in January of maybe high 200s to at peak panic in the sort of mid-high 400s. But in a recession, they normally go to 600 or even wider than that. And similarly with triple B corporates bond spreads, the extra yield you're getting on a triple B corporate, lower rated investment grade, reach about 150 basis points peak panic. But again, that is nothing like what you see in a recession. It can be even 250 or wider than that. So there hasn't actually been that much volatility, I think, within credit. So when we think about what I've been doing and also what the wider fixed income team has been doing at Fidelity, and I think a lot of people, I can't speak for everyone because people do have slightly different views, but I mean, there's definitely a common theme within the fixed income fund managers to be worried about credit valuations in particular, where things were priced for perfection and there was no bad news really priced in. So I think everyone really went into this in pretty good shape and being underweight credit risk. And what I've seen certainly on the desk in the last few days and even last week or so is people have been covering that a bit. I think people have been going more bullish of credit as we're starting to get compensated a little bit to take the risk. But I don't think people have gone piled in and gone, fully overweight and very bullish on credit valuations yet. So I think in terms of rates as well, we've seen people, I think, had a bit of a long duration bias. People really, like myself, did doubt this kind of US exceptionalism narrative. We didn't think US growth was going to be 3% forever, but markets almost went too far the other way. Suddenly the markets are pricing in bad recession and potential crises in some markets anyway. And again, I think people have generally been fading that. So, whereas there had been quite a lot of long duration positions, people have been taking those off. I think what we've seen now, given the news in the last day, is obviously quite a big sell-off in US rates in particular. And that's something which I have started to nibble at a bit, actually. I think that US government bonds are starting to get a bit more attractive. Could talk about that a little bit more later. But ultimately, exactly as you've heard just now, the uncertainty, and Matt said the same thing, but the uncertainty and weaker growth, it means that all else equal, you should have lower treasury yields and lower interest rates. And I think the big risk of a huge inflation spike in the next year is clearly much reduced. So I think that US interest rates, US government bonds are beginning to look a bit more interesting again.
Let's maybe pick up on one of those elements. How concerned are you by the action we've seen in treasuries over recent days and weeks?
Yeah, there has definitely been dysfunction. If you look at measures of liquidity in treasuries, it's not as bad clearly as what we saw in March 2020, when you could barely trade a US inflation-linked bond for 1 or 2 weeks of March 2020. But we are seeing impaired liquidity. I wouldn't say it's disastrous. And I've seen in fixed income desk at Fidelity that we have been doing trades, and yes, the bid offer spread is wider than normal, but I wouldn't say it's at crisis levels. So I think that liquidity is impaired, but better than what we've seen in previous crises. I think the other implications of clearly, if the risk-free rate there becomes a bit unanchored, and that's what we have seen at the long end, not so much at the short end actually. Markets began pricing in rate cuts, and short-dated treasuries are really a view of where policy rates are going to go in the next year or two. Now that's been moving lower as you'd expect. The market's been pricing in the chance of policy cuts, but it's the long end that's a bit of a concern. You've seen a big spike in long-dated bond yields in the US and therefore around the world. I think the impact for, obviously, if the risk-free rate becomes a bit unanchored, that's not good for any asset class. So again, the lessons from COVID in 2020, this can easily spill over into other asset classes, which arguably was beginning to happen. But I think for the US economy itself, actually, if you get a big surge in long-end bond yields, it doesn't affect things too much. I mean, as long as the front end is well behaved, and if even actually the long end, mortgage rates actually haven't skyrocketed on the back of the treasury sell-off because they're priced off swaps, and swap rates haven't really moved that much. So I think things have been relatively contained in the US, and probably hence why we haven't seen much of a reaction from the Fed or any communication about potential reactions to these moves. Where I'm probably more concerned is where you get spillovers from the US to other countries. And actually here in the UK is quite a good example of that, where the UK clearly has very little fiscal room, and this applies to many, many countries around the world. When you have a big sell-off in government bonds in the US, you tend to see high correlation across other markets, and we've seen a very big sell-off in long-dated gilts, for example. But this itself means you have even less fiscal headroom than you had before, which is where you can start seeing US problems spill into bond markets everywhere else, which can create problems in those markets. So I think that's where the bigger concerns are. I mean, just today, we've seen a bit of a rally back in the long end of gilts and other markets, but that is definitely something to watch, is where you get spillovers from treasuries into other countries.
Thank you. Niamh, coming back to you, how are our equity portfolio managers responding to the current environment?
Thanks, Jan. The first response to that is that they are continuing to approach their mandates as they have been for many years and in line with client expectations. In other words, the defensive portfolios, the income portfolios continue to be extremely resilient in the current market conditions. They were invested in stocks that were not pricing for many years of future growth, that had strong free cash flow underpinning. The same is true of our value portfolios. Across portfolios that are more core or that had growth dynamics within them, our portfolio managers are going through them again, both at an aggregate level to try to understand, are there areas that are more leveraged that may be more problematic now than had been the case in the past? Are there cases where, as Ollie has outlined, there was an established supply chain that now needs to be completely re-evaluated? And is that risk, or is, in some cases, the opportunity being correctly priced in the stock? So they're, again, going through stock by stock, sector by sector, region by region, but all the time they are very much respecting what clients expect in terms of the mandate that they have. Across all of our teams, the team are responding to what is structural and systematic change, and this happens all of the time. The world does change. We need to change within that, and we need to understand what is correct through time, what is continuing through time, and where we need to react and adjust.
Thank you. Oliver, coming back to you, how does the research team in times like this go around finding the longer term opportunities amongst this volatility?
Yeah, I mean, what excites me during times like this, and I think the rest of the analyst team, is the sense that the market's throwing up opportunities. And you know, we're one of the privileges here at Fidelity is we're given the license to think long term, to think about what the changes in the tariff regime or the global economy mean for these companies that we know well and covered for a long period of time. And you know, as Niamh said, the key question I'm asking myself, or other analysts, is how has the normalized earnings power of the companies I cover changed in this regime? And you know, there are some stocks which have sold off because have sold off correctly. There might be some examples of stocks which sold off because the market misunderstands the complexity or nuance of the tariffs they cover. Some stocks have sold off because they are starting to price in a recession. And if we can look through the coming recession, there are opportunities for companies that look attractive on the other side of a downturn. But the most interesting thing is, as Niamh was saying, the most interesting is which companies benefit from this this change in the world order. Where is the market misunderstanding that the midterm outlook is better than it was? And you know, I'm not going to talk about any specific companies, but to give you an example of the sort of thing that I and the team have been thinking about is, you know, it seems very likely that the outlook for US manufacturing capex, you know, the revival of US manufacturing, which we started to see under the first Trump presidency and then the Biden administration, that continues. And yeah, and so there are companies which will benefit from higher manufacturing capex in the US. And given you know, the level of unemployment in the US is low, given the age and the de-skilling of the manufacturing workforce in the US, it seems likely to us that industrial automation, companies that provide industrial automation equipment, could well be mid and long-term beneficiaries of the change in the world order.
Mike, coming back to you, are there areas where you feel short-term pricing has become disconnected from longer-term realities? And if so, how do you play some of those opportunities from here?
Yeah, just for context, you know, we're global. Fixed income go anywhere in terms of our remit. So, you know, we can take views across rates, inflation, credit, and even FX. I feel, you know, as I mentioned just earlier, that, you know, rates are getting more interesting in the US. We do have a long duration bias. I feel that, you know, as already discussed on this call, that the uncertainty which was chronic is still chronic, and that is going to be driving growth weaker, I feel. And the inflationary risks, which were there, are not as big as they were, but they're still there. So I think that actually that's quite a bullish rate story. We tend to have a long duration bias, and that's a view that's held really across the fixed income team more widely. Credit I've covered already. I think credit's valuations have got better, but they're not necessarily cheap. So we've covered some of the underweight, but not really too bullish in that space. Inflation is interesting. Obviously tariffs are inflationary. The market has priced that entirely as being transitory, and that's still the case. We've seen market implied inflation in the US for the next year, which had been at 4% at one point at the peak yesterday. It's still at 3.5%. But what's interesting is you look at next year, it's only pricing in 2.3% CPI, and it's about the same thereafter. So there's really not much inflation priced in beyond the next 12 months. So I think that we are liking inflation protection. It's very cheap. And if you think US inflation is cheap, look at Eurozone. Euro inflation is priced in a less than 1.5%, only rising to 1.7% from next year and thereafter. So, if you do believe that supply deliveries are going to be upended, and there's a lot of disruption from this, which I think I agree with, there's very little in the way of inflation priced in, which is quite interesting. And I think the final thing I'd comment in terms of things that actually I think have got too cheap is EM, emerging market debt, particularly currencies and local currencies. Now, if you believe that the policies that the US administration is pursuing will ultimately be a weak dollar, which is my view. And the dollar is and has been about the most expensive since the mid-1980s, as recently as the end of January. And it's only come off a little bit from those levels. A weak US dollar should normally be very good for emerging markets. And if you believe that global growth will be weaker, but not too bad, actually that could be the ideal environment for EM. We're already seeing announcements of lots of fiscal stimulus from all countries around the world. Obviously there's a global growth hit from current policies, but I don't believe that it's going to be massively recessionary. And I think that environment of a bit of a muddle through where growth is weaker, but not too weak, where you've got a weak dollar and potentially you've got actually quite a dovish Fed, could be the perfect environment for EM. And you look at valuations, EM currencies on the whole, very, very cheap. EM real yields are way in excess of what you see in developed markets. Brazil or Colombia have inflation of 5% or lower and falling in the case of Colombia. Local yields are at 12% for Colombia, almost 15% for Brazil. So incredibly generous real yields. So I think that whereas 12 years ago EM valuations were horrific, right now, and we always talk about valuations, there's so much bad news priced in. I think actually that is definitely worth looking at.
Thanks, Mike. So we've heard some thoughts from the equity team on opportunities. We just heard from Mike on fixed income. Matt, coming back to you with a cross-asset perspective, where are you and your team looking and finding opportunities at this point where we are today?
Yeah, we have to remind ourselves that we're still in a world that's rewiring itself long-term and got some instability medium-term. And so the kind of themes that we like are domestic earnings that are a little bit out of the wind of the global picture. Places where we have earnings picture that is more clear and more confident, where we can really understand that they'll come through. And also quite rate sensitive earnings in the equity side. And an example of that is our global equity income guys at Fidelity have been absolutely knocking it out the park. And I think they'll continue to do that in terms of their performance recently, because they're just ticking those boxes and then finding alpha within it. I think across other asset classes, what we saw was some indiscriminate selling. So even gold was going down in the areas of volatility. When you actually think about this scenario, gold probably does pretty well. I'd back up the point on tips and inflation link that Mike just made, and also earning some duration here. We've struggled with equity and bond correlations being high in the last few years, but actually we think growth is probably going to play a bigger role over the next 6 to 9 months. And so actually owning some duration in your portfolio makes sense. And then finally, I'll just touch on currencies. The dollar is a complicated one. It normally strengthens in weakness, or what we call the dollar smile. Here, it's a bit more complicated given the policy. I would earn yen and Swissy as good defensive assets. If we see rates coming together between Japan, which is on a different cycle to the US, we could see yen protecting your portfolio. So that would be a place to add money.
Great. Thanks, Matt. Sticking with you, and especially you're the only member of the panel based in Asia today. We haven't covered China, and it's a really important part of the puzzle. both in terms of its own cycle, but also obviously the announcement yesterday from Trump regarding tariffs towards China. What is your thinking on China? What's the outlook on China from here?
Yeah, I mean, China's in a bit of a tricky spot given the current growth backdrop and the policies. But what you got to remember is China takes a really long-term view to things. And I think they're going to do the same here and see through this tension with that long-term outlook, which will stand them in good stead. And we could well see some stimulus. I think the other point is to remember they've made real incredible strives with AI recently, and that's not about physical trade particularly. And there are some stocks that would have really sold off linked to China, linked to that AI play that could be really, really interesting.
Thank you, Matt. We've got time for one more question before we have to close. So, Niamh, I'm going to come back to you, really for a medium to longer term perspective. What does this mean for the equity markets? What do you think about direction and performance on the longer term perspective as we look beyond the short term volatility?
Thanks, Jan. As I mentioned already, volatility happens all the time. Systemic change happens all the time. We tend to assume that voter preferences stay the same, regimes stay the same, alliances and allegiances stay the same. But the reality is that these fluctuate all the time, and sometimes they fluctuate really, really dramatically. What do we know is likely to continue? Firstly, most of the world is still in favor of pushing for the mutual benefits of trade and seeing the benefits of that in economic growth. That remains true for most of the world. Innovation continues at pace. Again, if anything, that seems to be accelerating rather than decelerating. And major governments are not completely immune to pain. This is helpful information. We had thought that to be true. That now looks to be reinforced. So as I think about the longer term outlook for global equity markets, I think there may be a change in the longer term ordering and a change in what has been very clear exceptionalism from the US. If we look at Europe nearer term, trade openness is suddenly a big relative advantage, which before it was standard, but now it's a relative advantage. Some of the major economies like Germany are in a decent fiscal position. The governments are coming together and working together. You've got really great corporates. You've got reasonable valuations. So you have parts of the market where you can see a really good setup that has improved in recent months over the coming years. But if the number one and number two economies in the world, US and China, are at loggerheads, and if they head into a recession, the entire world will not be immune. So that's a long way to say, Henk Jan, that I do think we still have a bright future ahead, but it may be a rocky road to get there.
Great. I think that's a perfect way to end. I'm afraid we're out of time. Thank you very much to everybody on our panel. Thank you to the audience for joining us. Thank you for your questions. See you next time.